It's really great to be here. When Bridger asked me if I would talk, oh, by the way, the 1,000 deals, that sounds really impressive until you realize that I've been doing this for about 40 years now, so it's really, I'm just old. So, but hey, that works. No, when Bridger asked me to come and speak with you guys, I said, well, what would be most helpful to them? And he said, well, we've got people that have never done a fund before. We've got people that are kind of in the middle of doing one, people that have it going, and people that have done it a lot. I said, okay, well, that's helpful. And he said, I said, well, what else can you tell me about him? He said, well, some of them are doing real estate funds. Some of them are doing hedge funds. Some are doing crypto. Got some private equity people, and then there's this category of other. It's like, so all you have to do, Roland, is just give something to them that will help all of them equally at the same time in 35 minutes. It's like, okay. So that's what I am going to do for you guys today. I'm very passionate about this. I love deals. And so I'm going to walk you through and what several things that have worked for me, right? And kind of where I am right now and what I'd like for you to think about, whatever kind of fund you have. Let me just see. How many of you guys have a fund that's already got some stuff going on, some investors? Okay, cool. That's great. And how many of you are doing real estate? Good number of you. Okay. How about crypto? Okay, and then private equity, buying and selling companies? Okay, cool, thank you. All right, great. So then I'm just going to kind of walk through things that I would like for you to think about. How does this apply to me each time that I'm sharing this with you, okay? Because I've been doing it for a long time, so I have teams and I have a lot of systems in place. I've got a whole lot of tech I'm gonna share with you. Don't feel like you have to do all this stuff. Just look for the things that are the one thing that can help you. That's what I try to get from each person that speaks at a conference is what's the one thing that could actually help me? Okay, so can we hit the slides? All right. That is not one of my slides because I don't like to look at myself. So, okay, cool. So what I want to talk about is achieving alpha. Lessons that I've learned from 1,000 deals. Who knows what alpha is? Anybody? This young lady, you raised your hand right there. Tell us what alpha is. Shout it out. Is the number one of the group. Yes, that's great. So what we're trying to achieve, we're always trying to achieve alpha when we're investing. How can we outperform the benchmarks of other people who are competing for the dollars that we want to have under management? And how can we do that without taking what we call asymmetrical risks that are too great or greater than those that the other people are taking? So if you run a real estate fund, well, I think that's where I start. Yeah, so the first thing you got to say is, what's the benchmark for the category of fund that you have right now? Because if you can achieve alpha, you should have all the money coming your way because not a lot of people can do that, right? And if you can do it consistently, then you're pretty set for life. Because this is a great thing to do. So how can we consistently achieve alpha? Well, that's what we'll talk about. But you got to know what the benchmark is. What is the benchmark? So if you have a real estate fund, the average return for real estate funds is about 12.99%. If you have a crypto fund, congratulations. As long as you're hitting the 128% return, you're doing good. And you know what? That's going to last forever. Promise. Gonna last forever. PE, though, has been around for a long, long time. PE is mostly what I do. I do a lot of real estate as well, but I love to buy and sell companies. And PE averages 14%. We do a whole lot better than that, right? That's the benchmark. Alpha is better. So there's three primary parts of your business that I'd like for you to think about also when we're going over the things we're talking about today. So you have the front office. The front office, you're focusing on a few different things. You're focusing on how am I managing risk with the portfolio of either companies or investments or coins or whatever it is that you have. How am I managing that risk? And then what am I doing in terms of analytics to actually have some idea where things are going? And then Am I doing research? I've got people that are doing that. I also have to source deals because it's important to have deal flow, whether it's real estate deals or crypto, new opportunities in crypto, or if it's in private equity. And then how do I select the deals that I'm actually going to do? What is my acquisition criteria and due diligence? So if you don't, this might be like you might have all these hats on now. But ultimately, one thing that I learned was if you can buy back your time, that's going to help you tremendously. And that can be at home, that you're not cutting the grass or cleaning the house because you've got somebody doing those things for you. Or it can be in your business where you're like, well, what are the lowest value uses of my time? The sooner you can buy back your time from those menial tasks that don't return well, the better you're going to be. So you've got a front office. And then you also have what's considered the mid office, which not a lot of people think about. That is also risk management, but compliance. And what is the risk of non-compliance, and how are we addressing that? How are we onboarding new clients that are investors and new clients that are companies we're acquiring? How do we gather all of the assets that we've got? And then what are we doing for automation? How many of you are using automation of any kind right now? A few of you. Okay, thanks. All right. Back office. Back office is the boring stuff unless you're an accountant, in which case you get very excited about it. And that is accounting. Super, super exciting. Trade and settlement. Your cost seg studies, particularly if you're in real estate. How am I allocating my basis to different parts of the business so I get the biggest tax benefit? What's my liquid asset valuation? And that good old transfer agent that's taking care of moving people in and out. So there are three keys that I have identified are really, really helpful to achieving this alpha. The first is to have, and they're very tech enabled, I will tell you, because the more that you can automate, the better off you're going to be. And you're going to see that the bar for you versus your competition in this world is so shockingly low. It's so shockingly low. Just a few little things that you do to automate the business can really have a tremendous effect. So the first is your sourcing stack, right? How do you get quality deal flow? This is important because if you can get in deals, whether it's real estate or crypto, I had a buddy of mine that his brother founded a thing called Angel List. And we had dinner last night, and he's talking about a deal that he put together in the crypto space. And we took out a $500,000 chunk of it, was all we could get in the fund, but we actually got $1.5 million, and we allocated another $1 million to really key players in the crypto area. So that's going to bring in some pretty good opportunity. We just cashed out on a crypto thing, I think it was BitClout, that we invested in last year and sold it just a month or two ago for 9x, right? That's because we were able to get in early. What I want you to do in doing what we're talking about today is to be able to get in early also. When you have quality deal flow and you've got a deal scoring system, which I'll talk about, then you can move through deals really, really fast. The second thing is the opportunity stack. The opportunity stack is all the stuff that's coming to you. How do you manage that? How is Tiger able to close a deal a week? That's impressive, right? That's moving at speed. And then your creative stack. What creative deal structure things can you do so that the deployed capital that you've got as a ratio to your portfolio value is as good as it can be? Meaning that if we can get a whole lot more leverage by being creative and get into more deals with less capital, our returns will go up, achieving alpha, okay? So this is probably hard to read, but the only thing I want you to take from it is this is where your competition is. If you look through all those bars, the second one down shows you the greatest adoption. Those little kind of purpley bars on the far right, those things are, do I have a laser? No, I don't think this is a laser. I'm afraid to punch it because sometimes it'll blow things up. But anyway, the purple on the right is the adoption. The blue on the left, which is the big long bars that have the highest percentages, is how many private equity funds are considering doing this. The one that has only 32% adoption, you know what one that is? Can you read it? What is it? Cutting edge stuff. Unbelievable bleeding edge. Social media. Yeah, 32% of them are all over that. I'm telling you, for you to be able to use just a few of these tools is going to put you so far ahead of everybody else. Okay, so now let's talk about why I'm going to encourage you to get a little techie. Okay? And you don't have to be good at it, by the way. You can get people to do that. Again, buy back your time. So a couple of advantages. So in the pre-transaction, like before you get to a deal, it's going to help you get your speed and accuracy and also in your deal pricing. It's going to help you do modeling. How many of you are doing modeling in your funds already? A few of you. Okay. Modeling is very powerful, by the way, to sell. It's important so that you know what's going on, but it will also help you sell and market and get people to invest. So financial scenario and growth models, and then social media and market signals that are going to help you identify unique investment opportunities. We'll talk about what those are too. From ops standpoint, you can do virtual data rooms. How many of you are doing data rooms already? A couple. Okay. I really appreciate that feedback. It helps me kind of see where you all are. So a data room is just a way for, I'm a recovering attorney, so people like I used to be, to charge a huge amount of money for a Dropbox account. Okay? That's a data room. So a virtual data room, I don't know how you would not have it virtually. I guess you walk into the computer? I don't know. Anyway, so you have virtual data rooms that allow people to go and see all the deal documents. And you can give your LPs, your limited partners, who are your investors in your fund, you can give them access to those documents, and they can even import, export, and slice, dice, Julian, fry all that data through their own processing systems. And robotic automation, so what can you do to automate tasks like accounting and trading and settlements and things like that? And then tech enabling your onboarding so you don't have to do so much of it. That's really important. And your compliance reports, and all of you that get up to 150 million in assets under management will get to file a Form PF. And that just means that you have a bunch of money under management, and they want to be sure that SEC does that you're doing good things, okay? And then portfolio benefits of tech. So you've got, if you can basically take the companies that you are acquiring, or the real estate deals that you're getting into, or the crypto opportunities that you have, and I would encourage you to get past just buying the deal. I would encourage you to think about, how do I get into the picks and shovels? How do I get into the infrastructure of these deals? Because there's a lot of money in that. So if you're a crypto investor and you're just raising money to buy crypto, to buy coins or to buy NFTs or whatever, how do you get into the infrastructure behind that that's supporting all that? There's a lot of opportunity there. Same thing with real estate, same thing with PE. You can enhance your strategic planning and your growth modeling, that's always good, and getting better deal flow, okay? So I want you to use tech to find value and price your investments. I want you to use it to manage and optimize your portfolio, to help you with exits as well, identifying the opportunities for exit. Tech can be super helpful there, and also help you with your tax planning and reporting and all that kind of fun stuff. Okay, so getting into some specific recommendations of the sourcing stack. This is identifying prospects and using data and services. So this would be PitchBook, and Source Scrub and Clearbit would be important tech for you to look at, okay? Look at all this stuff. The opportunity stack, how do you manage the opportunities that come and stay in touch with them? That's typically CRM type things. So you can use Salesforce, you can use Affinity. There are deal-specific things, and there are general things. The deal-specific things are not as good, honestly, but they do have templates and things that help you to move faster. So Microsoft Dynamics 365, and then the marketing stack, the one that, and this is where we have a company called Digital Marketer that I own part of, that we're very, very adept at, but this would be like Outreach, Drift, good guys over at Drift, by the way, and HubSpot. So this is a good basic tech stack for you to have ultimately in your fund to help you acquire correctly and at the best value and at the best speed, to be able to manage the opportunities that you've got, and then to be able to actually run the deals, okay? So key number one of these three keys, the sourcing stack, this is repeatable, predictable, scalable deal flow, okay? There are 23 for you private equity people that are buying companies, and all of you that aren't yet, buy companies. It's amazingly cool, okay? 23 million, what they call untransacted or non-transacted companies, meaning that none of us has gotten a hold of them yet, okay? 200,000 transactics, people that have already done deals with us, and 6,000 public companies. So there's a tremendous opportunity, okay? But only 13% of the private equity funds use any technology to reach them at all. Remember, social media is this amazing, exciting thing to them. 22% of them are using marketing technology, but 65% of them basically got nothing. So if you do any of this stuff, you are ahead of almost all of the people you're competing against for deals, because you shouldn't have to compete for money. There's so much dry powder. Dry powder is cash sitting on the sidelines looking for deals. There's trillions of dollars of dry powder. If you have a deal, you can get money, you can have people clamoring to give it to you. But you've got to have deals. And that's why I wanted to focus on this part. Now, here's something that's interesting. If you do use tech, your internal rate of return, which is how sophisticated investors typically measure how well they're doing, is about 8.3% higher than the average, instant alpha. Your deal transaction volume increases on average 55%, just because you put a little bit of easy tech in. That's pretty significant. Okay, so here are some things that you can kind of take, and I would just take a picture at the end, and I sent the slides, so these guys have them, and it's totally cool for me to give them to you if you want them. Do you want them? Yes. Okay, cool. No, you're alive. It's so great. It's after lunch. It's like, shouldn't have had the California burrito. Okay, non-transacted. Here's a whole bunch of companies that you should look at. Now, these span the spectrum of price and sophistication. So I tried to put things in there that would be good for everybody. So you can look at them and say, if I want non-transacted tech, here's about 5 or 6. If I want transacted, deals that are already done, here's a bunch. From simple to complex, from relatively cheap or free to relatively expensive. You then want to enrich your data so that you know more about the companies that you've got. So you have a company now, how do you put a whole bunch of data with it so you know about them? And then relationship data, and honestly, LinkedIn is just the best one of those. So I would encourage you to check out this tech, okay? It can be very, very helpful to you, and it will put you miles ahead of everybody else. Then you got to nail your acquisition criteria. How do I know what ICO to invest in, or what company I should buy, and what does it look like, and what real estate deals should I say no to, right? How do I actually do that? Because the more you can say no faster, the more you can find the unicorn deals that you want to do. So you'll have your investment thesis, which typically is the argument for investing in a specific target. Well, I like this target because it's got a good upside, and the market is doing this, and so on. You've got the investment theme, which is like the overall market segment that you're focused on. Like one of our focuses is live events, okay? And then you've got your ICP, your ideal customer profile, which is just all of the data points that you've collected either from yourself or other deals that you've seen done successfully that are the exact perfect deal that you would like to have. And then you got to figure out, where are those people, right? Where are those deals? So things to think about is, what's the market position? What is the customer sentiment? If you're not in the deals that you're looking at how happy are the customers of these things, that's one of the best indications of how well something's going to do. And it's something that in due diligence has become omnipresent. It's in all the deals now. What's the NPS score? What's the net promoter score? What's customer satisfaction look like? Okay? What is the historical performance of the people? Not just the deal. The people, because the people are the deal. People can screw things up, ask me how I know, so many times when there's a great deal because they are messed up, right? So be sure that you're investing in people who have had success in the past too. Look at your industry trends, because a rising tide raises all boats. It's much easier to ride a tailwind than to fight a headwind, even if it's a good deal that you're trying to justify. And then what does cash flow look like? Because we got to keep things going, even if it's a profitable company. We got to be sure that everything's able to pay for itself, okay? And then last but not least, are there going to be a whole bunch of capital expenditures? I'm going to have to spend a whole bunch of money on stuff. And if I'm spending all that money on stuff, how long is it going to last? If you're in the AV business, this stuff is out of date the day you bought it, right? Crypto, of course, it's going to last forever. So, and I like crypto, so I like to make fun of it. So if you're starting out and you want to kind of have this, this is to me a beginner's acquisition criteria checklist. So I filled it out, and I can put a form in without all my stuff in there, but I filled it out to help you see. kind of the things you look at. If you're just starting out, do something that you like. Look at your hobbies and interests and passions, inventory those, and be sure that it's something you like, because this stuff isn't as easy as you think it is, okay? You're going to run into challenges, and if it's something you like, you'll stick with it, and if you hate it, you'll find lots of ways to either blow it up yourself, accidentally, subconsciously, or you'll just say, that's too much work. Then you're going to inventory your experience, your superpowers, and your skills, the things you're good at. And then circle the ones that you think you would actually like to be involved with the fund for, right? Or the types of things you would like to invest in, and then move your thesis and your theme in that direction. Something I'll talk about in a minute is lower left corner, which is if you already have portfolio properties, how to grow them fast is to figure out what needs they have, and then acquire the needs that will solve their problems. And then on the right is just financial. How much money do you want to make? How much money do you want to make to get in distributions from the fund, from the companies, for the fund to get from the companies, for your investors, etc. Okay? Now, this is a more complicated criteria, and I'm going to run through it at a decent clip because this is the one that we use in acquiring deals with a big event company that's owned by Blackstone. So we sold one of our companies to Blackstone a couple years ago, and now we are working with the company that we sold it to be the finder of the deals, which is pretty cool because they have $800 billion. You meet with 3 of those guys in the room and their net worth combined is $160 billion. It's like, that's when you think you're doing well. So I come home and I'm like grumpy and my wife's like, what's wrong? I'm like, I'm not worth $160 billion yet. Okay, all right. All right, so here is the criteria that we use. Much more sophisticated and much more robust, right? We want to know sector. Does the target deepen an already prioritized acquirer position, et cetera, right? And again, I'm not going to read the whole ones of these. Geography is important. So they are currently prioritizing the United States and Asia, right? Think about geography when you're thinking about your acquisition criteria. What about scale? Is this something that's going to make an impact? When I first started doing deals in New York, up on Wall Street and Water Street, they called them SLDs, which was, I guess, small little deals. I'm not sure what the S stood for. But they won't do a deal that's not going to actually be meaningful. And little deals to them are pretty significant. To you, you have to figure out what's the scale that makes sense for you to focus on. Is the target growing? Is it outperforming the existing assets you got? Because if it's not, it's lowering your IRR, and that's going to make your fund less appealing to the investors, okay? Quality. Is there a good quality of earnings? Can it bounce back if there's some, I don't know, like a pandemic or a war or something? Those things never happen, right? Management. Is management experienced, and can they do this, right? Do they have a good history? Is the operations model compatible with the rest of the business? And again, I'll give you these. This is just kind of let this wash over you as things that you should be thinking about. Is that okay? Okay, because I can slow down and just cover like 2 slides if you prefer. Okay, all right. So that's the operations model. Then tech. This is a big deal. How well does the target's tech integrate with our fund and the other companies in the portfolio? How easy is it to integrate this thing that we're acquiring into the other things that we've got? Then you can also source by need. So this is a form that I use to brainstorm acquisitions for portfolio companies. And I just say across 7 categories, what do we want? Do we want more market share? Then we'll buy our competitors. Do we want more leads? Then we're going to go and buy media that has our ideal customer profile already aggregated. Do we need more infrastructure or resources? We're going to acqui-hire. We're going to acquire other companies that have operations teams, dev teams, those kinds of things. Do we need to increase our AOV in the companies, the average order value that people are spending? Then we're going to go buy companies or assets that add products or services. Do we need to increase our lifetime customer value? If so, then we are going to buy recurring revenue type assets. And those are very favored right now. Do we need to increase our profit margins because we're not making enough money right now, or we want that to be higher? Then we're going to vertically integrate and acquire our suppliers, distributors, outsourcers, etc. Or do we need to acquire innovation because our offerings are stale? Then we're going to acquire IP, intellectual property, patents, trademarks, copyrights, that kind of stuff. So this is a good thing that you can solve for any need with acquisitions, which I love. You can also source by network. I'll give you a whole bunch of places to network. This is like, you can laugh at friends and family and employees and things like that, but I can't tell you how many deals come just by saying what you do. I've got a fund we invest in, and then whatever your thesis is, or whatever you're looking for. And many funds are analyzing 80 plus deals just to find one. That's a lot of wasted effort. So how do we not do that? We basically use lead scoring on the opportunities, any opportunity, whether it's a piece of real estate, whether it's a company, whether it's a crypto asset. We want to basically score those. Some things that we can do to do that is monitor the data signals to find these deals before they happen. What are some of the things that we could monitor? Well, growth. And I'll give you specifics too. What about what's going online on the web? What about the people that are involved in the company? What about the investors that are investing in the company? What about the events the company is attending or going to or exhibiting or speaking at or presenting at? What about recognition they're getting? What about ownership changes or investors or investments? What about the news? What about growth intent? So these are signals that say, if you watch them, you can get in before anybody else does, before the other tens of thousands of funds come in. Because it gets competitive, and when it does, when they're competing, it's a bidding war, and the price goes way up, and your IRR goes way down, okay? You monitor these data signals. The most probably recognized one would be Google Alerts, but shockingly, there are lots of other companies, including those that are free, that you can use to monitor these signals. So if you put in the companies, deals, people, et cetera, that you want to find out how they're doing, then you can monitor them and see when an alert triggers to tell you that one of these signals has happened, okay? So again, because you'll have these, I'm gonna go relatively fast. Growth signals are they hiring additional employees? Did they take additional office space? Have they moved or acquired a new location? Is there a new geo that they're going into, right? Or a new market that they're expanding into? Are there new products or services that they've launched? Web signals. Have they expanded their social media channels? Are they now doing TikTok instead of YouTube? That is an indication. These are all just clues, right? Has their social following grown? Are their SEO rankings peaking? Do they have website traffic that's increasing? Have their inbound links increased, right? These are all easily monitorable. Have they expanded their board of directors? Do they have external board members coming on where it used to just be the couple of founders? That's a very good clue. Has the executive team expanded or been upgraded? That's a big clue. Are there recruiting campaigns that they're running right now? For investors, did they launch an initial round where they hadn't taken financing before? Are they doing a second or a follow-on? Are they doing a recap to get some chips off the table? Have they got a bunch of new investors that are coming in? Are there minority stakes that are coming in from smaller growth funds? Those are really good signals. Event signals, what's their exhibitor history at what events, and is it growing or declining? What about trade shows? What about speaking and keynoting? Are they doing a lot more of that? All of that usually comes ahead of a roadshow, right? Event sponsorships, are they sponsoring events? Did they buy a conference, right? We did. Recognition signals, are they getting recognition in the industry? Are they winning awards? Is there some buyer guide inclusion that they're in now that they weren't in before? How about an expansion of their reviews? Are they getting a lot more reviews than they did? Or are their competitors starting to cite them as the people they need to go up against? We're better than that company, and that didn't happen before. That's a clue. Ownership signals, what is the ownership type, structure, or reincorporation? When they reincorporate out of Idaho into Delaware, it's a good indication that they're about to do something financial, right? Good clue. Restructuring and reorganizations, are they shuffling the people around? Have new owners come in? Did they start acquiring other businesses? News signals, are they announcing new hires? That's easy to track, right? How's the media coverage? Is it increasing? Did they just start really upping the public relations efforts, and maybe they've got some owned media expansion, they're buying media, or they're acquiring other assets related to that? And then last but not least, growth intent. Are there new job postings that they're putting out there? Are they expanding their markets? Are they doing geo-cloning, taking what they've done and just dropping it in another territory? Franchising, licensing? Are they acquiring IP and companies with M&A activity? That's all cool stuff. Opportunity stack, CRM based. This is customer relationship management, right? So this is all these kinds of companies. These are all great CRMs. Some of them are deal specific, some of them aren't. They're all worth a look. And you'll find that different people like different things. We do not mandate that our portfolio companies use any particular thing. They get to pick, but it's got to be good. Automation based on sales and marketing. There's a bunch of companies that do that really well, and several of these are deal focused as well, okay? And then managing it and monitoring with better reporting. So if you use a data warehousing resource like Amazon's Redshift or Snowflake, and then put Tableau or Looker or one of those guys onto it, it can be pretty powerful. Just look into this. Again, I just want to give you ideas. And then your creative stack, which is my favorite part of this whole process, negotiating, structuring the deals, creative deal structures. So earnouts are evolving. What can you do to decrease the amount of capital you have to deploy to acquire the same value asset? When you do that, your IRR should go up. Can you take longer to pay the owner, and can it be contingent on something like profitability or growth or compound annual growth rate or something like that? What about reps and warranties insurance? So a lot of deals used to be 10% or so of the sales price, or the purchase price, would go into escrow for 3 years or 5. And at the end of that, if everything was okay and claims didn't exceed a certain amount, the owner would finally get that. That's a lot to be tied up. If you want to attract deals faster, you can protect yourself by having insurance that covers that. It'll cost you about $250,000, not a lot, to be able to get a deal that could make you millions. Offer to pay the reps and warranties insurance for the seller as the acquirer. Now you're protected and you'll get the deal. And trade that against the basket, which is that withheld 10% that usually happens. That's a really smart thing to do, okay? It can get, so the whole thing is, how do I get deals that nobody else can? You be creative. Be creative. You can do 338H10 deals, which allow your seller to be able, it allows you to buy assets, which you typically want to do, so you can capitalize and depreciate them. And also you don't inherit all of the who knows what that is the liability sitting with the company. So most of us want to buy assets, but most sellers would rather sell their stock for the cap gain. This allows you to have both. Definitely worth working into if you can qualify. If they've owned the business for more than 5 years and it was an original purchase, they may be able to exclude $10 million of the gain on the sale under 1202. Knowing about these things gives you an edge, because if you can tell them about that and nobody else did, and you structure the deal so it works out, you win the deal. You win the deal. Type F reorganizations allow the seller to retain a small interest. They don't have to sell everything, and they can do a rollover tax-free. There are all kinds of other reorganizations too. I use these a lot. I mean, like a lot. It's amazing. I can save somebody $500,000, $1 million, $5 million in taxes. I'm gonna get the deal because I'm the person that figured out how to do that, okay? JV and minority investments. So if you can't do the whole deal yourself, or they don't want to sell the whole thing right now, take a little piece. This is a very big strategy of growth funds. Just let us buy 10%. Just let us buy 20%. And give us a board seat, and give us some covenants, and give us the first right of refusal on any additional funding, right? Just that. It's in the document. It's a standard thing, right? SPACs, special purpose acquisition companies, forming them or merging with them, still a big opportunity. Lots of shenanigans going on with those, but also big opportunities, something that's worth looking at. PIPEs are private investments in public equities. This is where you're basically going outside the market to do a deal, right? Then you've got club deals. Club deals is basically just co-investing. It's when one or more funds go together. You could also do a fund of funds. Like if you don't want to have to make any of your investment decisions, just buy a bunch of funds. Now you might have to be an RIA, a registered investment advisor, or something like that to do it, but it is a great strategy. Lots of people that have public cachet use. Lots of people that have a lot of followers will just put together a fund of funds, and then people come in because they're buds, right? They're like, oh, you're smart and rich. Can I give you my money? Right? That's what those club deals are. And then equity clawbacks, where you're saying, I'll give you, Mr., Miss, or otherwise binarily identified seller, I will give you a bunch more equity in the new company. I'll do a stock swap. I'll give you a lot of equity, but if certain things are the case, then I love the way they said, I'm gonna claw it back. I'm gonna claw it back. I'm gonna take it back if those certain things don't happen. And then last but not least, lots of different kinds of convertible debt. A couple of creative alpha enhancers. I'm gonna go through them very fast. Carve-outs, you don't buy everything that's on offer. You take some of the things out, the price goes down, you still get what you want. Seller financing, always ask. I always ask, and I never offer interest, and probably 50% of the time I don't have to pay it. Earnouts, I mentioned before, super strong. Earnouts are great for when you can't agree on the price and they want more and you want to pay less, and you say, if it hits all those things you say it'll hit, then I'll pay you that in a couple of years. Factoring, accounts receivable, sell those off to other people. Asset-based lending, use the assets, the physical assets and borrowable assets of the business to get financing. RBF, revenue-based financing. Very often we'll go in and acquire a company and then do an RBF deal and pick up a couple $1 million in financing that we can use to pay off the deal from the transaction history that the company already had. Integrator equity is try to get the people who are working in the company who have not yet had an opportunity to get equity to get equity. They will perform better because now they're owners and they'll give you money. Tranched PPMs. Don't ever raise more than you need to go into a deal. If it's your portfolio company and you're thinking about raising money to make it go, don't raise more than you need, because each time you raise, you should identify how much do I need to raise to get to the next level of valuation. Then stop. Hit the next level of valuation with the money that you raised and then raise again. Do it in tranches. Consigned inventory. If there's a lot of inventory, rather than having to come up with the money to buy it, just tell the seller you would like to continue to have it, and as it sells, you'll pay them the cost of the inventory. So they consign it with you. You keep the title, you don't have to pay for it. You get to basically pay for it over time without any interest. And last but not least, supplier term extensions. So if you are in a decent sized deal, let's say it's buying $200,000 a month in something, if it doesn't have credit, which many of them don't, especially smaller deals like that, if you can get the suppliers to extend credit for 90 days, you've just picked up $600,000 in cash one time, but it's just a windfall. Is this stuff helpful? Okay. You guys gonna go buy some stuff? Gonna get some investors and do this fun thing? Come on, give me a yes. All right. Thank you very much. I really appreciate you being here, and really appreciate you letting me share the stage with you.
If you want a lot of additional really cool stuff, I've got a whole channel full of it, and you should subscribe so that you don't miss any of it, because I'm uploading videos all the time. There's a lot of things that are changing in this area, and you don't want to miss out. You don't want to do it wrong, and you don't want to make the mistakes I made. Subscribe so that you don't miss out, and then check out this next video.